For generations, global financial power was a physical endeavor. 19th century banking dynasties dictated sovereign debt and industrial monopolies through tangible capital control, ink and paper ledgers, and private couriers. J.P. Morgan orchestrated markets through physical banking syndicates and trusts, exerting influence by directly embedding his representatives on corporate boards to enforce his interests. Today, that influence has migrated to a different class of institution: massive asset managers like Vanguard and BlackRock, and quantitative trading firms like Jane Street and Citadel. Financial hegemony has moved past physical bottlenecks. It functions through a decentralized, tripartite digital architecture. This system is built on three specific pillars: a massive concentration of corporate voting power, algorithmic market execution, and structural tax secrecy. Dominance today depends on invisible digital capital routing, rather than the visible ownership of physical assets. Historically, financiers built monopolies through direct ownership. The modern asset manager achieves market leverage passively. Vanguard and BlackRock collectively manage over $20 trillion in assets. They act as the central clearinghouses for global equity. Through these funds, they hold significant voting stakes in more than 8,500 global companies, representing the largest shareholder in competing firms. This scale is a product of mutualized ownership. By pooling trillions from individual retail accounts into exchange-traded funds, these firms acquire immense voting blocks without deploying their own proprietary capital. That consolidated voting power allows these managers to dictate environmental policies, determine executive compensation, and steer corporate strategy across the S&P 500 simultaneously. This structure grants these firms the ability to steer the global economy while remaining insulated from the traditional risks associated with direct capital investment. The second pillar relies on speed. Power is locked behind cryptographic walls and proprietary mathematical models, rather than banking vaults. Quantitative funds use high-frequency trading to capitalize on latency arbitrage, exploiting microsecond delays. These algorithms operate within the blind spots of human traders, executing thousands of microtransactions to extract fractional profits. This velocity introduces a systemic fragility. When algorithms cascade, they trigger flash crashes, vaporizing billions in market value before human regulators can intervene. Emerging markets serve as the primary targets for this extraction. India, a $4.1 trillion economy with high retail participation, has become a testbed for automated profit siphoning. In July 2025, India's market regulator, SEBI, banned the quantitative fund Jane Street from its securities market following a massive derivatives investigation. SEBI detailed how hyper-fast algorithms manipulated derivatives to siphon $4.4 billion in illicit profits out of the Indian market. When algorithmic profits of this scale are extracted and moved offshore, they drain the liquidity needed to stabilize the domestic financial system. This rapid drain on cash reserves mirrors the mechanical collapse of the 1997 Asian financial crisis. Like the 90s, the sudden removal of liquidity can trigger a regional currency crash and sovereign debt default. Latency has been weaponized, transforming emerging economies into highly efficient extraction mechanisms for offshore quantitative funds. For nearly a century, financial privacy was defined by the Swiss Banking Act of 1934 and its system of numbered accounts in Zurich. Digital transparency laws, like Switzerland's 2026 LIDA overhaul, are systematically dismantling these historical safe havens by mandating federal beneficial ownership registers. Financial secrecy has migrated from the vaults of the Alps to the structural gaps of global regulation, led by a new primary jurisdiction. This chart tracks wealth hidden in selected secrecy jurisdictions. In 2016, the Cayman Islands served as the world's most used destination for offshore assets. By 2020, the distribution shifted. The volume of hidden wealth stashed within the United States more than tripled in just 6 years. In 2021, the US officially surpassed traditional havens like the Cayman Islands and the UK, sheltering over $2.8 trillion in hidden wealth. The United States achieved this by refusing to adopt the OECD's Common Reporting Standard, making it the only major financial center that does not automatically exchange account information with other nations. This creates a structural loophole where the Tax Cuts and Jobs Act allows asset managers and algorithmic funds to shield globally extracted profits within the U.S. legal framework. By rejecting international transparency standards, the United States has positioned itself as the foundational tax haven for modern financial hegemony. This unified architecture begins with a foundation of U.S. regulatory secrecy and offshore shielding. That foundation supports the active mechanism, high-frequency algorithms siphoning liquidity in real time. Directing the system is the massive capstone of asset management concentration, leveraging retail equity to dictate corporate policy. This opacity engine functions as a closed loop, concentrating corporate voting power to set terms, extracting wealth via algorithmic speed, and shielding that capital through deliberate regulatory blind spots. The banking dynasties of the past required boardrooms and physical ledgers to project power. Today, trillions in capital are routed and concealed through computer code at a scale that completely bypasses national borders. Traditional oversight, designed to regulate human traders and physical assets, lacks the tools to monitor a digital machine operating at this velocity. Effective regulation requires real-time trade reporting, mandatory audits of proprietary algorithms, and forced public disclosure of country-by-country corporate profits. Without restructuring global transparency, sovereign economies remain vulnerable to systematic extraction by invisible, algorithmically driven entities.